I'm Emily Chang, and this is Bloomberg Technology. Coming up, Apple's roughly $400 million bet on facial recognition technology. We'll break down the investment in Finis. Plus, 1 day to go before the big vote to reset the internet. Former FCC Chair Tom Wheeler joins us to discuss the way forward if net neutrality is repealed. And T-Mobile's big plans for the small screen. We'll hear from T-Mo as the telecom giant prepares to take on TV. But first, to our lead. Apple's appetite for deals grows. The tech giant is investing nearly $400 million in Finis, a maker of laser technology that's critical for the new iPhone 10 features like facial recognition. This coming just a few days after Apple confirmed it bought music app Shazam for an undisclosed amount. Shares of Finis have had their best day since 2009, soaring more than 20% at one point. Here to discuss, we are joined by who else but our Bloomberg Tech reporter, Mark Gurman, who covers all things Apple. So walk us through this deal.
So this deal is part of Apple's billion-dollar pledged fund to invest in manufacturing in America. Obviously, this has come on the heels of President Trump and his proclamations about everything needing to be manufactured in the U.S. So they're investing $390 million in a Texas-based company called Finis. They make lasers that they can put in a bunch of different products, from the AirPods, the little black circles you see inside the AirPods. Those are lasers shooting into your ears so they know if they're in your ears. So when you take them out of your ears, they stop playing. You put them back, they continue playing. It's a laser used for Face ID, so it can recognize your face. So it's an extremely important component for Apple's latest, string of products.
And it's currently in the iPhone 10?
They're currently using sensors like Finis makes in the iPhone 10. Now they're going to be investing in it. They're sort of going to put a chokehold on that market of sensors so they can use them in other products down the road.
So how many jobs are they creating here?
Lots of jobs. What's happening here is with the $390 million, Finis is going to be able to reopen a plant in Texas that had previously shut down. Now they're going to be able to rehire a bunch of people to work at that facility.
Will this alleviate any supply chain challenges?
That's a good question. In a sense, yes, because that amount of money, the $390 million, is going to ensure that that amount of money is invested in those components that Apple will need. They're going to be able to work years ahead on them.
So right now, this tech is being used in the Animoji technology as well. Explain that.
So the technology, the lasers, is based in Face ID, and that replicates with Animoji. So if you have an iPhone 10, it could scan your face. It knows it's you. Then the sensor, the lasers, could also be used for Animojis, so it knows your facial structure, if you're opening your mouth, if you're smiling, if you're shaking your head. But like I said, it's also used for the AirPods as well. So there's broad applications for the tech.
Gene Munster is saying that the deal gives Apple a competitive advantage when it comes to AR. Would you agree? Absolutely.
Apple has actually been ahead of the pack in terms of AR. They are one of the first companies to recognize the importance of AR over VR for smartphones and glasses and such. And so what you're seeing here is Apple really investing even more deeply in this technology, more than you've seen other companies like Samsung or Google do in recent history. We reported earlier this week, you reported on Apple buying Shazam. How does this new news give us more insight into their M&A strategy? I mean, are they on a spree? So you see, actually, that's a good question, because you see two different paths happening right now. You're seeing Apple doing more investments, technological investments, in order to prepare for its future, but also, big-time acquisitions, such as what we saw with Shazam. Shazam, they bought the whole company, the technology, the people, and the resources. They're going to integrate it in the company. So that's one arm of the M&A strategy. The other arm are these big investments, not full-on acquisitions, but giving companies money in order for them to have enough resources to build components that Apple needs down the road. So you think we'll see more of this? I think we'll definitely see more on both paths. Okay. Mark Gurman, our Bloomberg Tech Apple reporter, thanks so much. All right, Target is getting ready to bring same-day delivery to most of its stores next year. The retail giant is purchasing grocery delivery startup Shipt in a $550 million all-cash deal. The deal will give Target same-day delivery at about half of its 1,800 stores by next summer. The move could help beef up Target's logistics operation as it tries to keep pace with the likes of Walmart and Amazon, who also offer same-day service. Coming up, the internet superhighway may be in for some slowdowns. We look at the FCC's upcoming vote to repeal net neutrality. And Bloomberg Tech is live streaming on Twitter. Check us out at Technology, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg.
The FCC will vote Thursday to repeal the Obama-era internet protections known as net neutrality, rules designed to make the internet equal for all. So what happens if the vote goes through? Bloomberg's editor-at-large, Corey Johnson, has that answer.
Well, just as government rules created the interstate highways, government rules created the information superhighway, a cliche to be sure, but a useful metaphor. And what better metaphor to explain the controversial idea of net neutrality than a drive on the internet superhighway? Our ride? A bandwidth-hogging, gas-guzzling beast like Steve McQueen's 1968 Mustang GT in Bullet. Think of this car as a metaphor for, say, a movie on Hulu. We hit the interstate, the backbone of the internet, at full speed, as fast as 100 gigabits a second. The backbones are owned by some big companies like AT&T, CenturyLink, Deutsche Telekom. And all of our fellow travelers are traveling the same road at the same fast speeds until we reach the exit. But that last mile is owned by a small group of internet service providers like Comcast, Spectrum, and Verizon. Without net neutrality, the last mile will have different rules of the road. We have gone off the information superhighway to blazing fast speed, but now we're hitting traffic. Without net neutrality, a Netflix 18-wheeler monster truck could pay to motor right past everyone else, buying their own fast lane, leaving competitors in the dust. Net neutrality requires that the last mile providers treat everyone the same. An Obama-era FCC voted to codify those protections in 2014. But now Republican FCC commissioners, led by now Chairman Ajit Pai, want to unwind those rules, abolishing net neutrality and potentially letting ISPs decide the winners of the road.
Our Bloomberg editor-at-large there, Corey Johnson. Now, to discuss more on Thursday's looming vote, I'd like to welcome back the man who oversaw the installation of those protections, Tom Wheeler. He was the FCC chair from 2013 to 2017. Welcome back, Mr. Wheeler. So the FCC and the FTC have said in their memo of intent that the FTC is empowered to enforce these potential new rules. Do you trust that they would do so?
Well, I think the FTC is a fine organization populated by good public servants. The problem is that their statute doesn't give them nearly as much authority as the FCC has, and they are not an expert agency like the FCC is. I mean, Emily, I think the key thing here is that since 1934, the FCC has been created by the Congress and charged with the responsibility of overseeing the important networks of the nation. And for the first time since 1934, with this decision, the FCC is washing its hands, walking away from that congressionally mandated responsibility. And they're only doing it for the, most important network that will define the rest of the 21st century. It's an inconceivable kind of action.
So let's take Comcast, for example, which said it won't violate net neutrality rules once repealed. A spokesperson for Comcast said any reporting that we're preparing to offer paid prioritization is absolutely false and inaccurate. Do you trust that, given that they were one of the companies who fought for years against it?
Well, I think there are probably a couple of answers to that, Emily. One is if they've got no problem with it, then why are they against the rules? And secondly is let's look at how Comcast's commitment, which is what they call it, to internet access has changed over the last year. They used to see, when they were dealing with me, they used to say we are against paid prioritization. Now they don't say that. Now they only say that we're not in support of unlawful prioritization, and discrimination is the word they use. And there's a big difference. If you are either for fast lanes and slow lanes, or you're against fast lanes and slow lanes. They used to say that they were against it. Now they don't say that anymore.
Now, Representative Marsha Blackburn was on Bloomberg TV earlier today talking about how she believes internet protection should be enacted. Take a listen to what she had to say.
No blocking, no throttling, addressing latency. Those are proper steps, but they should be taken by Congress, by the People's House, by the Senate, signed into law by the President, and it shouldn't be something that changes every time you have a change of administration or you have a new chairman of the FCC.
Mr. Wheeler, what do you think about a legislative fix for this issue?
Well, the fascinating thing is that Ms. Blackburn and her Republican colleagues in the House have also been flip-flopping around on their position. You know, when I was dealing with them, the line was no blocking, no throttling, no paid prioritization. But again, notice that whole thing about paid prioritization, about fast lanes and slow lanes, is off the table. They don't talk about that anymore. So the important thing is, if there is any legislation, is it legislation that is moving backwards and taking things away that exist for American consumers today, or is it moving forward? The fact of the matter is that the open internet rule is today the law of the land, and what's going to happen here is that the Republicans are taking away the protections that now exist for American consumers.
We have to talk about these fake comments that appeared in the public comment section, which the vast majority of the overall comments in favor of net neutrality, these fake comments overwhelmingly against. Attorney General Eric Schneiderman saying approximately 1 million fake comments on net neutrality were submitted to the FCC using stolen identities. Soon they'll use that record to vote on the future of the internet. I'm with FCC Commissioner Jessica Rosenworcel. This vote must be delayed until we can get to the bottom of what happened. How serious is this issue of fake comments and the FCC's attempt to block an investigation of them?
Well, I think what's sad here is the FCC's attempt, the Trump FCC's attempt to block an investigation. I mean, you know, the portals to the FCC are open, and it appears by all the reporting that various players tried to take advantage of that and use bots and use fake names and have people who are dead file and this sort of thing. What's disappointing is that the Trump FCC isn't saying, here, come look, come take a look. Let's see what was going on. Help us solve this problem.
So, you know, we have a question from a viewer here about whether it's really better to favor the whims of a Google and Facebook rather than a Verizon and an AT&T who are really investing in the infrastructure of the internet.
Well, I think we go back to what Corey did in his excellent introduction of what net neutrality is, because there's a huge difference between Google, Facebook, Verizon, AT&T, and Comcast. One is that the networks are the highway. And do we want those highways to be fast, fair, and open? Now, I think probably what your viewer is commenting on is there is this untrue statement that's floating around out there that somehow the internet service providers have not been investing as a result of the open internet rule. But the fact of the matter is, if you look at what capital investments have been since the open internet rule was adopted, they have been climbing. You look at their revenues. The revenues are climbing. The profits are up. Their stocks are at record levels. And this... You know, so the fact of the matter is that they're doing quite well. None of them have said to the SEC or to any of their shareholders that their future ability to invest has been threatened. And so I think we have to differentiate between lobbying rhetoric and what's really happening in the financial markets.
What do you think happens in the inevitable lawsuit here? Do you see this order being upheld?
I hope not. You know, there'll be an interesting challenge in the court. The order that we passed went to court twice and was affirmed twice. That's an important precedent. And the question here is, has the FCC built a fact-based case, not an ideological case, but a fact-based case, that things have changed so dramatically in the last 2 years that they have to totally wash their hands and walk away from any of the responsibility that Congress gave them? And I think that's a heavy lift.
All right, former FCC Chair Tom Wheeler telling us what you really think. Thanks so much for joining us again. We are going to continue our coverage of the effort to repeal net neutrality on Thursday when current FCC Commissioner Brendan Carr joins us on the show after the vote. Coming up, could Amazon's Alexa help diversify your portfolio? That is the question keeping money managers up at night. Our Future of Investing series is next. This is Bloomberg. Bitcoin is having a rough 24 hours, falling as much as 8.7%. This following a series of record-breaking trading sessions as Bitcoin futures began trading at the CBOE. Earlier, Federal Reserve Chair Janet Yellen was asked about Bitcoin and was apprehensive about the world's leading cryptocurrency.
Bitcoin at this time plays a very small role in the payment system. It is not a stable source of store of value, and it doesn't constitute legal tender. It is a highly speculative asset.
All right, well, major investment firms have slowly been playing catch-up, incorporating new technology, though they are also fearful big tech giants will threaten their way of doing business. So, could Google or Amazon swoop in and push firms like BlackRock and Fidelity on their heels? Our Bloomberg News asset management reporter Sabrina Wilmer covered this topic as part of our Future of Investing series and joins us now from Boston. So, Sabrina, how might this happen? How might a Google or an Amazon disrupt BlackRock or Fidelity's business?
A Google or an Amazon could offer mutual funds or ETFs on their platform. They could also offer financial advice or brokerage services, so they could get into the business in a variety of ways. They could also get into the banking business. And you've already started to see this happen a little bit, where Alibaba in 2013 started offering a money market fund, and it's become the biggest money market fund in the world. So there's no reason that Amazon could do something similar, where clients could store their value, their cash, in a money market fund. So I mean, Fidelity and Google definitely recognize that after what happened with Alibaba. I meant Fidelity and BlackRock. And Fidelity is taking steps to protect against disruption by investing more than $2.5 billion in technology each year. And they took a stake in, they bought eMoney, which is a financial planning company, in 2015. And they've also been doing a number of experiments on Amazon's Alexa, working on some of the software where a customer could go in and ask where they are in their retirement plan or whether they would be able to meet their education goal. And Alexa would come back and say, you're not on track to meet your goal, but here are the steps that you have to take to actually meet that goal. So that's kind of a work in progress right now because they don't have voice authentication. Right now, Fidelity Labs is working on that, but the technology doesn't seem to be there yet. But that's one example of what the future could look like for these firms.
So
and BlackRock is also doing.
How likely is it, Sabrina,
sorry.
that future arrives?
There are a couple of things that are standing in the way of tech firms, including regulation. It's whether if they get into the money management business, they would have to be considered a fiduciary, and being a retailer is very different than being a fiduciary. And they also could take a reputational hit if they're managing funds and they lose money. That could also hurt their brand. But consumers are ready for this. There was a survey where more than 50% of high net worth individuals said that they would be willing to put their money with a Google or an Amazon, or have them manage their wealth. So, and I think they like the efficiency, but there are also some privacy concerns, and I think some people still want that human touch.
All right, Sabrina Wilmer, we'll have to leave it there. Sabrina, our asset management reporter, thank you so much. That part of our Future of Investing series. Coming up, T-Mobile US is snapping up closely held Layer 3 TV as the wireless carrier prepares to enter the crowded field of online television. Next year, we'll hear from the COO of the wireless carrier next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg.
I'm Alisa Parenti in Washington, and you're watching Bloomberg Technology. Let's start with a check of your first word news. President Trump spoke to middle-income Americans and young Republicans at the White House today to pitch the tax overhaul plan working through Congress.
If Congress sends me a bill before Christmas, the IRS, this is just out, this is breaking news, has just confirmed that Americans will see lower taxes and bigger paychecks beginning in February.
Final votes on the bill could come next week. And Senator John McCain is receiving treatment at Walter Reed Medical Center for side effects of his ongoing cancer therapy. That is according to the Arizona lawmaker's office, which calls the treatments normal. Senator Al Franken says Tina Smith will make an excellent U.S. Senator. Minnesota Governor Mark Dayton appointed Smith, his lieutenant governor, to fill the Democrat Senate seat until a special election next November. Franken announced his resignation last week after sexual misconduct allegations. Lawmakers in UK Prime Minister Theresa May's own Conservative Party gave Parliament veto power over the withdrawal treaty before the UK exits the bloc. UK MPs voted to change the government's bill in a move that guarantees Parliament will get a meaningful vote on the final Brexit deal in 2019. And Palestinian President Mahmoud Abbas is calling on the UN to replace Washington as a Mideast mediator. Abbas spoke at a summit in Turkey where Arab and Muslim leaders condemned President Trump's recognition of Jerusalem as Israel's capital. Abbas also suggested he might not cooperate at all with U.S. efforts to negotiate a peace deal. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Alisa Parenti. This is Bloomberg. It is already Thursday morning in Hong Kong. We're joined by Bloomberg's David Ingles with a look at the markets. David, good morning.
Very good morning to you, Alisa, from Hong Kong. Well, the early picture across markets here in the Asia-Pacific, 30 minutes, of course, to the open of the cash markets over in Sydney's. Equities looking mixed. Bonds are higher. Dollar down substantially across a lot of these major pairs right now. I'm just looking at some of the futures right now. We're looking to open about a fifth of 1% lower over in Japan. I guess that really speaks to how perhaps a stronger currency current here in the Asia-Pacific might be counterproductive to a lot of the equity markets here. Lots of data to look forward to. Jobs data comes out. Australia, 2 rate decisions here in Asia. And of course, we're looking ahead to the Bank of England's rate decision later on tonight, Asia time. And that's a wrap of your markets. I'm David Ingles. More from Bloomberg Technology next.
This is Bloomberg Technology. I'm Emily Chang. T-Mobile US has announced plans for a disruptive new TV service set to launch in 2018 and signed a pact to acquire Layer 3 TV to help build out the strategy. It's already shaking up traditional services. Shares of cable distributors fell in Wednesday's session after the news was announced. I caught up with Mike Sievert, T-Mobile Chief Operating Officer in Denver, and talked about the strategy behind the deal.
This is a market that is just filled with pain points, Emily. I mean, if you think about it, it's the most hated industry in America. 8 of the top 10 companies with the worst customer service ratings in America are pay TV companies. And so with our brand as the Un-carrier and our history of solving customer pain points in wireless, you know, we're poised in an incredible way to make a big difference in this $100 billion pay TV market.
AT&T and Verizon have been exploring the online video market as well, a step beyond the slowing wireless business. How is this any different than what they're doing?
Well, what you see from AT&T is more of the same. You see, you know, I mean, their way of getting into this was to buy DirecTV, a traditional satellite TV company, and then create bundles that people don't want. I mean, in order to get a decent deal on AT&T wireless service, you have to drill a satellite dish into the side of your house and be fed linear, one-way, uncontrolled TV services from outer space. I mean, it's no wonder people are leaving this industry in droves. You know, there's negative growth of 2 to 2.5% in this industry, but that doesn't tell the whole story. Millennials and Gen Z customers are leaving at rates of 25 and 30% a year. They're abandoning old-fashioned linear TV like satellite TV. So AT&T's strategy is entirely wrong. And you know, what we're essentially offering to do is bring together the best of mobile video and home TV and create something that's totally disruptive in a market that needs disruption really badly.
John Ledger, your CEO, is saying he expects the deal to close in a matter of weeks. What are your regulatory concerns given the DOJ's opposition to AT&T Time Warner?
We don't expect any. We'll close it right after the new year, right after Hart-Scott-Rodino, which we don't expect to be a barrier. So this is really exciting for us. I'm coming to you from Denver, where we just met with the team at Layer 3 TV, who are going to be one of the key ingredients of this new T-Mobile strategy. What incredible technology and what an incredible team, because you know, we're going to build a service that people have never seen before. You know, think about the services that we're forced to live with today with today's linear TV. I mean, you get this program guide and a little D-pad remote control and bloop, bloop, bloop your way through to try to find things. That pales in comparison to the level of engagement of social media fed mobile video that our customers have come to love. So we're going to bring together these worlds and make TV not an island of its own anymore and really change things up.
Now, the possibility of a Sprint T-Mobile tie-up has been simmering for years. It still hasn't happened yet. What is the status of that, and what are the chances of it happening still in this regulatory environment?
Well, as you know, we looked long and hard at it, and it's a shame it didn't come through because there were some great benefits to a merger like that. But I'll tell you one thing. We were looking at Layer 3 TV and the launch of T-Mobile into the TV experience with or without that deal. It made sense if we did that deal, and it makes sense by itself. And, you know, there's a reason. It's just this marketplace is a market that's moving way too slowly, and it's not serving customers' needs. And it's a $100 billion market that we're in an incredible position to disrupt as standalone T-Mobile.
So you're saying a Sprint T-Mobile merger is completely off the table, will never happen?
Well, look, I'm not saying that. I'm saying we looked really hard at it, and it didn't happen. And so what we're doing now as a team is we're doing what you would expect us to do. We're focusing on running this great company. And boy, it is a great company in a great space. We're the only ones with service revenue growth. We've just finished 18 quarters of acquiring more than 1 million subscribers a quarter. And the main thing people need to know is, as you look at T-Mobile as a standalone company, you know, all these worlds are converging. We like to say that all content and communications are landing on the internet, and the internet is transitioning to mobile. Well, here we are as a leading and the only growing mobile internet company, so we're in a great spot.
Our conversation earlier there with T-Mobile COO Mike Sievert. Coming up, Juniper Networks unveils its latest vision for networking solutions. CEO Rami Rahim explains why simpler is better. This is Bloomberg. We continue to watch for a possible deal announcement from 21st Century Fox and Disney. As for what's on the table in the asset sale, Fox is said to retain its real estate portfolio, including its storied film and television studio lot in LA, according to people familiar with the matter. The arrangement would allow the new spin-off, controlled by the Murdoch family, to rent studio space to Disney, while Fox News, the Fox Broadcast Network, and the FS1 Sports Channel would be able to remain on the property. Juniper Networks wrapped up its Next Work conference Wednesday, the company outlining its updated vision for simplified networking. It wants to change the way operators interact with the network, making human-to-machine interaction more intuitive and natural. Joining me here in the studio, Juniper Networks CEO Rami Rahim. Rami, thank you so much for joining us. Great to have you. So you spent a lot of time on stage talking about why simplifying networking is important. How would that make the market grow?
You know, when I joined Juniper 20 years ago, it was all about scale and performance, just keeping up with the insatiable appetite for network capacity. Today, I think the issue is complexity. Complexity bogs us down, it locks up talent, it causes cybersecurity risk. And the way we've put a stake in the ground saying that the way we're going to solve this problem for our customers is to abstract away that complexity, to take on the burden ourselves. And ultimately, I think that frees up the capacity for IT, for operators to grow.
And yet the router business, which is a huge part of your business, is shrinking, and companies are replacing the hardware with software. How do you overcome that?
The router business is sort of a flattish market all up, but there are certain segments of the market, like in the cloud providers, where routing is actually growing. So that has been actually a growth driver for us at Juniper. The other thing is switching and security are both growth opportunities for us. Switching has been a great growth driver for us historically. We expect it to continue to be a growth driver for us in the future because it's at the heart of the cloud transformation that's happening in the industry.
That said, some of these big cloud companies like Amazon, like Google, even Facebook have been actively talking about using their own software and becoming a larger part of the networking market. What is Juniper's play in that world?
Yeah, it is a competitive marketplace. We have peers in the industry that are competition, but we also in some sense compete with our customers, like the hyperscalers who have the ability to develop their own infrastructure. But we demonstrate, we have to act like we're always on our toes, innovating and demonstrating that we can do a better job than anybody, including themselves sometimes.
So you mentioned some of the opportunities outside of routers. You did miss the last couple of quarters. What is the plan to get back to growth, and what can we expect?
Yeah, it's a great question. We started the year with a lot of momentum. The second half of the year has been a bit more of a challenge, only because of the fact that we have a high degree of customer concentration. We serve some of the biggest customers, telcos, cloud providers, cable operators in the world. And that means that when there is a product transition or an architectural shift, as there is right now, it causes a bit of a hiccup in the business. But on the long term, as long as we remain relevant and competitive, which is exactly what we're doing, I'm very optimistic.
A lot of gross margin pressure in the last few quarters. What's happening there?
It's a few things. First, there are geographic challenges where we're betting on certain opportunities in Asia Pacific. There's supply chain challenges that is affecting the entire industry, especially around commodity pricing of memory. And then our business itself is shifting from routing and switching, et cetera. I think we've got it under control, and we have a plan to recover.
So there was a report that Juniper was the subject of a takeover bid from Nokia, a report not from Bloomberg, that Nokia denied. Would you listen to offers?
I'm running this company for standalone success. I think we've got a great strategy. We're executing well, and I'm optimistic about what's coming ahead.
Do you see yourselves as more of an acquirer?
Absolutely do, yes.
Of what?
So we first and foremost are focused on our innovation agenda, our internal organic innovation agenda, but we're always looking for capabilities along the lines of automation, making networks simpler that can help us accelerate our strategy. And there are great opportunities out there to be an acquirer.
The FCC is poised to roll back net neutrality tomorrow. What's your position on that?
We have always and continue to believe in a free and open internet that is great for all stakeholders and that encourages innovation all around.
So does that mean this rollback is bad in Juniper or your opinion?
It's a complex matter. It's a complex issue, but like I said, we fundamentally believe that we don't want to do anything that takes us back from a free and open internet that allows people to innovate and to make money off of it.
If this happens, how would it affect Juniper's business?
Honestly, we're sort of in wait-and-see mode right now, listening carefully and understanding what sort of an effect it would have. It's not sort of a black and white issue. There's a whole spectrum of ways that this could go at this point.
All right, Rami Rahim, Juniper Networks CEO. Great to have you here on the show. Thanks for stopping by. All right, still ahead, yet another China-based fintech company just chose to go public in New York. What's behind the growing trend? We'll catch up with Lightspeed China partners next. And coming up this Thursday on Bloomberg TV and radio, we will have full coverage of the European Central Bank decision, plus the following news conference with ECB President Mario Draghi in Frankfurt, all kicking off at 7:45 a.m. Eastern Time. This is Bloomberg. In today's Out of This World, astronauts on the International Space Station normally have to wait and see movies out in theaters on Earth, but they're getting one notable exception. Disney has arranged a screening of Star Wars: The Last Jedi aboard the space station as it premieres in theaters this week. Well, Jianpu is now the 5th Chinese financial tech company to go public in New York this year, having debuted just last month. Lightspeed China partners James Mi was an early investor in the online financial products platform. He was also one of Google's first employees in China. Bloomberg Tech's Selena Wang spoke with Mi from Shanghai and started by asking about this trend of Chinese fintech companies listing abroad.
The consensus is fintech market in China, it will be bigger than even in the fintech market in the U.S. And so you will see the first batch of the companies going IPO in New York Stock Exchange and in the U.S. But also there are other companies are being listed in Hong Kong. These are very substantial market cap companies. And you will see potentially even more next year.
But James, how concerned should investors be about the regulatory risk? One example is Qijian, a microlender that just listed a few months ago, but its shares are already plunging since the Chinese government said it would tighten regulations in the lending space.
Certainly. I think the government is really coming out with more regulation, and particularly for lending business through internet. There's just in the past week or two, and there's clear regulations on the total interest and the fee cost, and there's guidelines in terms of what's the appropriate numbers and it should be used. And I think that as the regulation usually catches up with the internet companies, and that happens in the online payment space and the online video space. And usually the company grow and the government try to learn and come up with regulations or licenses afterwards. And so that will help to further clarify the regulation. And I think there will eventually be a positive news for all the players in the space, and to have a clear regulation to stick with. And so this is certainly some uncertainties that's reflected in the volatility in the stock. And so that's something that the investor should also pay attention to.
Prior to joining Lightspeed, you had led Google's very early efforts in China more than 10 years ago. Bloomberg is now reporting that Google is trying to get back into the country, but this time with its artificial intelligence software. So what do you make of that strategy?
Yes, I think Google really recognized China internet market is really the biggest single country market in the world, and Google is definitely want to engage and serve the users in China. But I think there's certainly regulatory efforts need to be made, and I think Google is learning to develop a more sophisticated approach to engage with the government and to address the regulatory requirement. And I think as the internet technology world is developing from pure web internet to mobile internet, now more towards artificial intelligence-based services. So Google really has an advantage in that. So they developed the AlphaGo, which really has a very publicized competition between AlphaGo and the top Go player in China. And they also offer the real-time translation service between the Chinese and English, and offered through a mobile app that's specifically developed for China. So there are a lot of efforts to try to really engage the users. But I think there's still more work could be done by Google because the market is just too big to really ignore, and I think they fully realize that.
Lightspeed is also an investor in Tuja, the vacation rental service in China, and that's coming up against increasing competition with Airbnb, which has been much more aggressive there. So how do you see the market shaking out? Do you see any comparisons between Uber and Didi?
Yeah, I do see some of that. I think it's Airbnb is doing a fantastic job in the U.S. and European and other markets in the world, but the China market is very, very unique, and Tuja is really clearly the #1 players, and I think it's really requires the team to be very entrepreneurial and to be well funded, and also understand the local market and offer a local service. For example, vacation rental in US, you can basically list the listing on the internet, and the user can just subscribe and pay for the service. But China, that many of the owners of the apartments actually don't live in the same city, and the apartment is not very well serviced. So Tuja actually developed a property management service on top of the internet listing service, which is very critical to ensure high quality experience for users. So all these elements, I think it's not as easy for a global company like Airbnb to really easily adopt. And I think the similar things happened with Uber, which made a lot of investment efforts in China, but eventually really the top companies in China, Didi, really is well funded and a very experienced team, really eventually being able to continue to take a leadership position, and I think similar things will happen in the Tuja and Airbnb, the vacation rental space in China.
And on that note of funding, venture capital funding has increased dramatically in China over the past several years. Do you think the markets are overheated there?
In a degree, I think so. But these are cycles, and I think that reflects the investors' recognition that China is becoming the second largest venture capital markets. And if you look at the top global internet companies, public plus private, the top 20 companies, that includes Apple, Alphabet, Amazon, Tencent, Alibaba. 9 out of these 20 top internet companies are Chinese companies. So there's a tremendous demand for investors to access these markets. So we do see currently there's a lot of capital actually has come into the market, and I think that push up some of the late stage companies' evaluation. But overall, I think it's a very vibrant market because there's more talents coming to play for startups, and also the innovation. They are shifting from just a business model innovation in China, but there's more hardcore technology innovation, and so this is a very, very attractive actually for a venture capital investment point of view.
That was Lightspeed China Partners James Mee with Bloomberg's Selena Wang. And that does it for this edition of Bloomberg Technology. A reminder, we are live streaming on Twitter. Check us out at Technology, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. That is all for now. This is Bloomberg.